Okay, so you want to buy a data center, a windowless concrete building sitting quietly on the edge of town, humming with racks of servers, and every single company that touches the internet paying you rent for the privilege of storing their data inside it. No customers walking through a door, no foot traffic, no seasonal swings. Just steady, predictable, recession-proof cash flow from an industry that isn't going anywhere. That's the pitch, and it's the reason data centers have become one of the hottest real estate asset classes on the planet, with some of the largest investment funds in the world racing to buy or build them as fast as physically possible. The problem is that almost nobody outside the industry understands what it actually costs to build one, what it costs to keep the lights on, and how thin the margin for error really is. Once you're responsible for keeping thousands of servers alive 24 hours a day, 7 days a week, forever. Before you make a single dollar, you need to understand that a data center isn't really a building. It's an industrial power plant that happens to have computers inside it. The land, the concrete, the walls, those are almost an afterthought. What actually determines whether a data center succeeds or fails is something most people never think about at all: electricity. A modern hyperscale data center can require anywhere from 20 to 100 megawatts of continuous power, and the largest facilities being built today by the biggest cloud and AI companies are pushing well past that, some now approaching or exceeding the power draw of a small city. To put that in perspective, a single large data center campus can require more electricity than an entire mid-sized town. That means before you can even think about servers, you need a direct, guaranteed connection to a power grid capable of delivering that kind of continuous load, and in most parts of the country, that kind of grid capacity simply doesn't exist yet where you want to build. Finding a site isn't really about finding land. It's about finding land that happens to sit next to enough spare electrical capacity. And those two things are rarely in the same place. This is why data center site selection has turned into a genuine arms race. Developers now compete directly with utilities and regional grid operators for available power interconnection slots, sometimes waiting years, literally years, for a utility to confirm it can deliver the power a proposed data center needs. In some of the hottest markets, like Northern Virginia, which handles a significant share of the world's internet traffic, utilities have reportedly told new data center developers that available grid capacity is fully booked for years into the future. Developers have responded by chasing power wherever they can find it, buying land next to nuclear plants, negotiating direct deals with power generators, and in some cases building or co-locating with entirely new power plants specifically to guarantee supply. This single constraint, electricity availability, has become the single biggest bottleneck in the entire industry, more important than land price, more important than construction cost, more important than almost anything else. Say you've found a site with power secured. Now comes the actual construction, and this is where the capital requirements become genuinely staggering. A modern hyperscale data center facility, the kind built for cloud computing or AI workloads, typically costs somewhere between $10 million and $15 million per megawatt of capacity to build. Once you include the building shell, power infrastructure, cooling systems, and fit-out, a modest 20 megawatt facility, small by industry standards, can run $200 million to $300 million all in. A large hyperscale campus in the 100 to 200 megawatt range can easily cost $1.5 billion to $3 billion or more. The biggest AI-focused campuses being announced today, the kind built specifically to house the enormous computing clusters needed to train large AI models, have been reported at costs well north of $10 billion for a single site. These are not typos. This is an industry where a single building project can cost more than an entire professional sports league is worth. Where does all that money actually go? Roughly a third of construction costs typically go into the electrical infrastructure alone. Transformers, switchgear, backup generators, and uninterruptible power supply systems, designed to keep every server running even during a total grid failure. Another substantial share goes into cooling. Servers generate enormous amounts of heat, and keeping a facility running at safe operating temperatures 24 hours a day requires massive chiller plants, cooling towers, and increasingly, for the newest high-density AI server racks, direct liquid cooling systems that circulate coolant directly through the computing hardware itself. because traditional air cooling simply can't remove heat fast enough anymore. The remaining costs cover the physical building, security systems, fire suppression using specialized gases rather than water, since water and servers don't mix, and the raised flooring and cable infrastructure needed to distribute power and connectivity to every single server rack. And here's the part that catches new investors off guard. None of that includes the actual computing equipment. The server racks, the networking gear, the storage systems, that's a separate, ongoing capital expense that dwarfs even the construction cost over time, because unlike the building, servers become obsolete. A facility might be designed to last 30 or 40 years structurally, but the computing hardware inside it typically gets replaced every 3 to 5 years, as newer, faster, more power-efficient chips come to market. This is the trap that defines the entire economics of the business. You build a building meant to last generations, to house equipment that becomes outdated before your construction loan is even halfway paid off. Here's where it gets interesting, because the way a data center actually makes money is more layered than most people realize, and it depends enormously on which business model you're running. The traditional model is colocation. You build the facility, and you rent out space, power, and cooling to other companies who bring in their own servers. Pricing here is typically measured per kilowatt of power delivered per month, and rates commonly run anywhere from $100 to $200 per kilowatt per month in competitive markets, sometimes higher in supply-constrained regions like Northern Virginia. A customer renting 500 kilowatts of capacity, a meaningful but not enormous deployment, might pay somewhere between $50,000 and $100,000 a month, locked into a long-term contract, often 5 to 10 years. This is the layer that makes data centers attractive to real estate investors in the first place. Long, contractually guaranteed, predictable rent, not unlike a warehouse or office lease, except priced by the kilowatt instead of the square foot. The second, increasingly dominant model is the hyperscale lease, where a single massive tenant, one of the major cloud computing companies or, increasingly, an AI company training large models, leases an entire building or an entire campus directly, sometimes committing to power capacity years before the facility is even finished being built. These leases can run into the hundreds of millions of dollars annually for a single campus, and the tenant essentially pre-funds a significant portion of construction through the lease commitment itself. This is why so much of the recent data center building boom has been driven not by speculative construction, but by developers building specifically against a signed lease from a hyperscale cloud or AI company, dramatically reducing the risk of the project compared to building on spec and hoping tenants show up. There's a third layer that most people never think about: interconnection and network revenue. In major data center hubs, particularly ones that serve as internet exchange points, additional revenue comes from cross-connect fees, charging other tenants inside the same facility for the physical fiber connections that link their servers directly to each other, to internet service providers, and to major cloud platforms, all without that traffic ever having to leave the building. These fees are individually small, often a few $100s a month per connection, but in a dense facility with hundreds or thousands of interconnections, they add up to a meaningful, extremely high-margin revenue stream, because once the fiber infrastructure exists, the marginal cost of each additional connection is close to zero. So far, the data center sounds like a business printing money from guaranteed long-term contracts with some of the most creditworthy companies on Earth. Now here's the other side of the ledger, and it's where the fragility of this business actually lives. The single largest ongoing operating cost, by a wide margin, is electricity itself, and this is where the economics get genuinely uncomfortable. A large data center can consume tens of millions of dollars worth of electricity every single year, and unlike most other real estate, that cost doesn't stay fixed. It moves with wholesale power prices, which have become increasingly volatile as data center demand itself, along with electric vehicle adoption and grid modernization, has started straining the power grid in major markets. In some regions, the sheer scale of new data center demand has been cited as a contributing factor to rising electricity prices for everyone else on the grid, including ordinary residential customers, which has started to generate real political and regulatory pushback in several states. Cooling adds another enormous, continuous cost layer. Traditional air-cooled data centers can use a genuinely staggering amount of water for evaporative cooling towers, and in drought-prone regions, this has become an increasingly contentious issue, with some communities pushing back against new data center projects specifically over concerns about water usage competing with residential and agricultural needs. The newest AI-focused facilities, with their much higher power density per server rack, are increasingly moving toward liquid cooling systems specifically because air cooling can no longer keep up. But liquid cooling infrastructure is itself expensive to install and maintain, and it introduces an entirely new category of mechanical failure risk directly adjacent to sensitive computing equipment. Then there's redundancy, and this is the cost category that defines the entire risk profile of the business. Data center customers don't just want power and cooling. They want guaranteed uptime, because a data center that goes offline even briefly can cost a tenant company millions of dollars in lost business, and can trigger severe contractual penalties against the data center operator. This is why serious facilities are built with what's called N+1 or 2N redundancy, meaning every critical system, power feeds, cooling units, backup generators, is duplicated, sometimes fully duplicated, so that if one system fails, a backup takes over instantly with zero interruption to the servers. Building that level of redundancy roughly doubles the infrastructure cost compared to a facility with no backup systems at all, and maintaining it means running, testing, and servicing equipment that, in a best-case scenario, never actually gets used for its primary purpose. And here's the trap almost nobody outside the industry sees coming. A single moment of downtime can undo years of profit. Major cloud providers have experienced highly publicized outages that took down large portions of the internet for hours at a time, and the financial and reputational damage from those events dwarfs almost any single year of rental income from the facility involved. This is why data center operators spend so heavily on redundant systems, extensive testing, and round-the-clock monitoring staff, because the cost of that infrastructure, however enormous, is still smaller than the cost of a major outage. At a facility housing hundreds of millions of dollars worth of a tenant's critical infrastructure. Before we get to how this industry has evolved, it's worth understanding the shift that's currently reshaping it entirely, because it explains almost everything about why data center construction has exploded over the last few years. For most of the data center industry's history, growth was driven by ordinary cloud computing. Companies moving their standard business applications, websites, and databases off their own private servers and onto rented capacity in someone else's facility. That was a real, steady growth story, but a relatively predictable one. Then came the artificial intelligence boom, and it changed the power and cooling requirements of the entire industry almost overnight. Training large AI models requires enormous clusters of specialized processors running at extremely high power density, far beyond what a traditional data center rack was ever designed to handle. A traditional server rack might draw 5 to 10 kilowatts of power. A modern AI training rack can draw 40, 80, sometimes over 100 kilowatts in a single rack, an order of magnitude increase that has forced the entire industry to rethink power delivery and cooling design from the ground up. This shift has triggered a construction boom unlike anything the industry has seen before, with major technology companies announcing data center investment commitments in the hundreds of billions of dollars collectively over just the next few years. But it's also created a structural risk that echoes what happened during previous technology infrastructure booms. Enormous amounts of capital are being committed based on the assumption that AI computing demand will keep growing at its current explosive pace indefinitely. If that demand growth slows, plateaus, or if AI training becomes dramatically more efficient, requiring far less raw computing power per unit of output, a very real possibility given the pace of efficiency improvements already being reported, some of these massive facilities built specifically for today's AI workloads could face a genuine risk of being oversized or underleased relative to what the market actually needs a few years from now. This is the same fundamental tension that has run through every previous infrastructure boom in history. Enormous fixed investments get made based on demand projections that assume the current growth curve continues indefinitely, and the operators who survive the inevitable correction are rarely the ones who built the fastest or the biggest. They're the ones who built against contracted demand rather than speculative demand, maintained financial discipline even while competitors were racing to announce ever larger projects, and structured their facilities with enough flexibility to adapt if the specific technology being housed inside them changes faster than the concrete around it does. So does owning a data center actually work as a business? The honest answer depends enormously on how the facility was financed, who it's leased to, and how disciplined the operator was during the build-out. In the optimistic scenario, you own a facility with long-term leases signed to creditworthy hyperscale tenants, power secured at favorable rates through direct utility agreements, redundant systems that have never actually needed to fail over because the underlying equipment is well maintained, and a location in a market where power and land constraints keep new competing supply from flooding in and undercutting your rental rates. In that case, the contracted rental income, the interconnection fees, and the sheer difficulty of replicating that power access elsewhere combine to produce one of the most durable, long-duration income streams available in real estate, the kind of asset that pension funds and infrastructure investors are willing to pay enormous premiums to acquire. In the realistic bad year scenario, your facility was built speculatively, anticipating demand that hasn't fully materialized. Electricity costs spike as regional grid strain worsens, squeezing your operating margins on the tenants you do have. A major tenant's business shifts, and they don't renew a lease that's coming up for renewal, leaving a significant portion of your power capacity sitting idle, unable to be quickly released because building out a competing facility's worth of redundant infrastructure takes years, not months, meaning that even if demand eventually returns, your specific building may not be positioned to capture it. Meanwhile, your fixed costs, debt service on a facility that likely cost hundreds of millions or billions of dollars to build, redundant system maintenance, security, and staffing continue regardless of occupancy. The gap between these two outcomes, for facilities that looked similarly promising at the moment ground was broken, has become the defining risk of this entire investment category as the industry races to build faster than almost any real estate sector in history. Let's build a realistic scenario. A developer builds a 30-megawatt colocation facility for a total cost of roughly $400 million, financed with 65% debt. At full occupancy, leasing capacity at $150 per kilowatt per month across 30,000 kilowatts of usable capacity. The facility generates roughly $54 million a year in rental revenue, plus another $3 million in interconnection and cross-connect fees, for total revenue near $57 million. Operating costs, electricity for common systems and cooling, staffing, security, insurance, property tax, and maintenance on redundant infrastructure, run approximately $18 million a year, leaving EBITDA of roughly $39 million. Annual debt service on the $260 million in financing runs close to $16 million at current rates. That leaves roughly $23 million in free cash flow, an attractive return on a facility with long-term contracted tenants. Now introduce a bad stretch. Occupancy falls to 70% as one major tenant doesn't renew and the space takes 18 months to release in a softer market. Revenue drops by nearly a third, while fixed costs, the debt service, the redundant system maintenance, the staffing needed regardless of occupancy barely move at all. That $23 million in free cash flow can collapse toward break-even or worse within a single year, even though the physical facility, the power connection, the cooling systems haven't changed at all. A data center looks, from the outside, like the ultimate passive income real estate play, a windowless building full of guaranteed long-term rent from some of the most valuable companies on Earth. From the ownership side, it's actually one of the most capital-intensive, technically demanding, and power-dependent businesses in existence, where the moat that justifies the premium valuation, guaranteed grid capacity in a supply-constrained location, is also the single hardest thing in the entire business to secure, and the one thing that can never simply be built faster with more money once a region runs out of it. The servers were never really the business. The electricity always was.